Las Vegas is facing a structural threat it was never designed to withstand. Jet fuel supply is tightening to levels not seen since 1963, and the entire strip depends on one fragile assumption: cheap and accessible air travel. Why is this happening? What is being hidden behind stable revenue headlines? Who is really benefiting as access to the city becomes more expensive and more restricted? At the same time, a second pressure is building inside American households: record debt levels that are quietly reshaping travel behavior. This is no longer a forecast. The shift has already begun, and the real story sits beneath the surface. If this analysis brings you clarity, consider subscribing and turning on notifications to follow the data behind Las Vegas. Las Vegas officially opened in its modern form on April 3, 1941, with the debut of the El Rancho Vegas, marking the beginning of what would become the Las Vegas Strip. The model was simple but powerful. Build large-scale resort destinations, attract mass-market visitors, and convert volume into revenue across gaming, hospitality, and entertainment. By the late 1980s and early 1990s, that model evolved into the mega resort era. Properties like the Mirage opened in November 1989. With a development cost of approximately $630 million under Steve Wynn, redefined the Strip. These were not just casinos. They were fully integrated entertainment systems designed to capture every dollar a visitor brought into the city. Over the next 3 decades, billions of dollars flowed into Las Vegas. Resorts like Bellagio, Venetian, and City Center expanded the scale and complexity of the Strip. The core assumption remained unchanged. As long as visitors could arrive easily and affordably, the system would sustain itself. At its peak, Las Vegas attracted over 42 million visitors annually, becoming the most visited entertainment destination in the United States. The city's position was built on accessibility, particularly through domestic air travel. But the contrast today is becoming harder to ignore. By 2025, visitor volume declined to approximately 38.3 million. Entering 2026, the downward trend continued. The issue is no longer demand alone, it is access. The system was built for scale. What happens when that scale begins to contract? The modern Strip no longer operates under a simple ownership model. Over the past decade, the underlying real estate has been systematically separated from operations through large-scale sale-leaseback transactions. This is where the structure begins to matter. Companies like Vici Properties and MGM Growth Properties acquired the land and physical assets beneath major resorts, while operators such as Caesars Entertainment and MGM Resorts International retained day-to-day control of the properties. On paper, this unlocked capital. Billions of dollars were generated through asset sales. But in exchange, operators took on long-term lease obligations, most structured as triple net leases. That means they are responsible not only for rent, but also for maintenance, insurance, and property taxes. These leases are not static. Many include annual escalators, often in the range of 2% or tied to CPI adjustments. That creates a built-in cost increase regardless of business performance. The critical detail is this: rent becomes a fixed obligation. It does not decline when visitor volume drops. It does not adjust when margins compress. It remains constant or increases. At the same time, many operators are carrying significant debt at the corporate level, with maturities staggered across the late 2020s. Interest expense, lease payments, and operational costs are now layered together. This is where the pressure concentrates, not in revenue alone, but in the rigidity of the cost structure behind it. recent performance data presents a mixed picture, and that is precisely what makes it difficult to interpret at first glance. In January 2026, Las Vegas Strip gaming revenue came in at approximately $747.66 million, representing a decline of roughly 11% year over year. That is a significant contraction for a core revenue stream that historically tracks closely with visitor activity. Then, in February 2026, the headline shifted. Strip gaming revenue increased slightly by 0.86%, reaching around $696.3 million. At face value, that suggests stabilization. But the composition of that growth reveals something more specific. Baccarat revenue surged by approximately 37% in that same period, disproportionately influencing the overall result. Without that spike, the broader performance would have looked materially weaker. Visitor data reinforces the underlying trend. According to the Las Vegas Convention and Visitors Authority, January 2026 saw total visitor volume decline by 2.2% year over year, even as convention attendance increased by 6.9%. This divergence matters. Growth is occurring in concentrated segments, business travel, high-value gaming, while the broader base of general tourism is weakening. The surface remains active. The foundation is starting to shift. This is where the structural pressure becomes visible in operational reality. The cost base of the Strip is no longer flexible. Lease obligations under triple net agreements continue to rise annually through built-in escalators, often around 2% or linked to inflation. These payments are fixed. They do not adjust downward when occupancy softens or when gaming revenue contracts. At the same time, operators are carrying substantial debt loads accumulated over years of expansion, acquisitions, and share buybacks. Interest expense has become more significant in a higher rate environment entering 2026. Servicing that debt now competes directly with operating cash flow. Then there is capital expenditure. Large-scale resorts require continuous reinvestment to remain competitive. Renovations, technology upgrades, and property refresh cycles are not optional. They are required to maintain pricing power. Depreciation continues to accumulate across multi-billion-dollar assets, while operating leverage amplifies every fluctuation in revenue. When visitor volume declines even modestly, the impact on profitability is disproportionately large. And the signs are already present. Discounted room packages, reduced flight capacity, softer midweek demand. These are not early warnings. They are active responses to pressure that has already entered the system. The structure is not breaking, but it is tightening. The pressure on the Strip does not exist in isolation. It is part of a broader shift across the Las Vegas tourism economy. Data from the Las Vegas Convention and Visitors Authority shows a growing divergence between the Strip and the local market. While premium, event-driven demand on the Strip continues to hold, the broader volume of everyday visitors is softening. This is reflected not only in total visitor counts, but also in spending patterns and length of stay. At the same time, passenger traffic through Harry Reid International Airport has begun to show signs of uneven recovery. Capacity adjustments by airlines, driven by higher fuel costs and route optimization, are reshaping how travelers can access the city. Fewer flights and higher average fares create a structural barrier to entry. Beyond travel, competition is evolving. The expansion of online gambling across multiple U.S. states is gradually reducing the necessity of physical travel for gaming. What once required a flight to Las Vegas can now be accessed digitally. Layered on top of this is the macroeconomic environment, elevated interest rates, persistent inflation, and record household debt are compressing discretionary spending. The result is a market that is still active, but increasingly selective. The system is not shrinking uniformly, it is shifting. On the surface, Las Vegas still looks strong. Revenue holds, events sell out, premium segments continue to perform. But underneath that surface, a contradiction is forming. The city appears busy, yet the composition of that activity is narrowing. Growth is being driven by high-end segments, conventions, and a small group of high-value players. At the same time, the broader base of middle-class visitors, the group that historically sustained the system, is quietly pulling back. This creates a structural paradox. The metrics that suggest stability are being supported by increasingly concentrated sources of demand. But those sources do not provide the same consistency or resilience as a broad visitor base. And that is where the long-term risk begins. Because a system that depends on volume cannot indefinitely rely on concentration. When accessibility declines and the middle layer weakens, the surface can remain stable for a period of time, but the underlying structure becomes more fragile. What looks like resilience may actually be compression. The central question is no longer whether Las Vegas is performing today. The question is whether the structure supporting that performance can hold under sustained pressure. Because what the data is showing is not a single cycle downturn. It is a convergence of forces. Rising fuel costs increasing the price of access. Airline capacity reductions limiting who can arrive. Fixed lease obligations locking operators into rising cost structures. And a consumer base facing record levels of debt. Individually, each factor is manageable. Together, they form a long-term stress test. Las Vegas has adapted before. It has rebuilt its identity across decades, from gaming hub to entertainment capital to global event destination. That history matters. But adaptation requires time, and more importantly, recognition of the shift as it happens. The risk is not collapse, it is misalignment, a system that continues to operate at full scale while its foundational demand base is gradually narrowing. The real test is already underway, not in the headlines, but in the data. If this breakdown helped you see Las Vegas from a different perspective, consider subscribing and turning on notifications for more analysis like this. And if you want to go deeper, watch the next video where we examine how mega resort debt structures are shaping the future of the Strip.